The European economy continues its good performance. Generally speaking, we expect that 2018 will again be a very good year for the European economy, although slightly worse than the previous year. Very important is that the European labor markets are performing very strongly. We see that there is a wage growth acceleration in most euro area countries, and in particular in Germany. This is very important for the European Central Bank because wage growth acceleration will contribute to higher inflation in the longer run. At this moment, we see that Eurozone inflation is slightly above 2%, the long-term target of the European Central Bank, but this is mainly driven by fastly increasing oil prices. In the longer run, we need more structural and more fundamental support for inflation, for the core inflation. This has to come from increased wage inflation, as we currently observe. The ECB is formally and informally announcing the end of its unconventional monetary policy. We expect that by the end of this calendar year, the ECB will end its asset purchase program. And we also expect that by the end of next year, the first rate hike will be applied by the European Central Bank. So that means it will be a very gradual normalization of European monetary policy, but nevertheless a very important change compared to the recent past. The immediate impact of those decisions and this policy change is that the long-term interest rates in Europe are increasing. In particular, we noticed that the German long-term interest rate started a very structural increase, although this was interrupted, mainly caused by some political turmoil in Italy. The Italian government has to come up with a new budget, and this budget has to be approved by the European Commission. Now, it's clear that the Italian government might clash with the European Commission on some of its proposals. A higher deficit on the Italian budget is probably unacceptable for the European Commission and may recall crises in Southern Europe as we have seen 10 years ago during the financial crisis and later on during the European debt crisis. So it remains to be seen how the Italian government will interact with the European Commission, but generally speaking we expect some more volatility in the months ahead. But ultimately we also expect that there will be a compromise between the Italian government and the European Commission, so the volatility won't last forever. Apart from Italy, another disturbing factor for the European economy is Brexit. Brexit is back on the agenda, in particular as it appears after a European summit that the negotiations between the United Kingdom and the European Union aren't going smoothly. It's clear that there are different opinions around the table in Europe, but also different opinions inside the United Kingdom. The probability of a so-called hard Brexit has increased, although this is not our main scenario. We still believe that a soft Brexit is much more likely than a hard Brexit, simply because a hard Brexit would cause substantial damage to the British economy as well as to various European economies. In particular, smaller, open European EU member states would be a victim of a hard Brexit. While the European economic cycle continues to be good, European growth is becoming more sluggish. On the other hand, the US economy is continuing its very impressive boom. We also see that the US job market is outperforming. There's a lot of job creation and wage growth is accelerating in the US economy. Consequently, the Federal Reserve, the American Central Bank, decided to increase interest rates again, to slow down the US economy and to avoid a hard landing in the US economy. A more restrictive monetary policy, in combination with good hard data for the US economy, is generally speaking also offering support to long-term interest rates in the US. Now, higher long-term interest rates are probably going to last, and we adapted our scenario that indeed part of the recent upswing we have observed in financial markets is going to continue. This has important consequences in particular for emerging markets. Emerging markets are very sensitive to a strong dollar in combination to higher long-term interest rates. Several emerging markets have financed their debt in US dollar and have loans outstanding at low interest rates. Now, when interest rates are increasing, this is going to put additional pressures on public finances in several emerging markets. Nevertheless, we still believe that this is a problem for some particular emerging markets, and we don't believe in an overall emerging markets crisis. To wrap up, the global economic outlook remains very optimistic. Nevertheless, we see a clear divergence between the very strong growth performance in the US economy and slightly weaker growth performance in the European economies. Labor markets globally are doing better than a couple of months ago, and this is contributing to inflationary tendencies in the global economy. This should allow a continued normalization of monetary policy, which causes some challenges in particular to emerging markets. But generally speaking, the economic outlook remains very optimistic.